All right, today we've got to talk about a pretty stunning claim from Palantir. You know, one of the most mysterious and interesting companies in tech. After their last earnings call, the CEO said something that really made everyone in the industry do a double take. So let's get into it.
And there it is, arguably the best results that any software company has ever delivered. I mean, think about that for a second. In an industry with absolute giants like Microsoft, Oracle, you name it, that is one heck of a bold statement. So the question is this just CEO hype, or is there something really solid behind it?
So yeah, let's unpack this best ever claim. It's time to look past the headline and get right to the numbers.
Now, the CEO didn't just stop there. He called their performance otherworldly growth. So let's decode these numbers and see what they actually put on the board.
Okay, check this out. The numbers are just wow. Now, they're a government business. That's their bread and butter. It saw really solid growth. But look at the U.S. commercial revenue. It exploded by 121%. That is huge. It shows they're really making a big move beyond their government roots. But believe it or not, this isn't even the number that gave the CEO all that confidence.
So in the software world, there's this really useful benchmark called the Rule of 40. It's pretty simple, actually. You just take a company's revenue growth rate and you add its profit margin. If that number is over 40, you're looking at a healthy, high-performing company. It's all about balancing that super fast growth with actually making money.
Well, Palantir didn't just beat the Rule of 40, they completely blew it out of the water. Their score was 114, and that is what's behind that best ever claim. I mean, to see a company growing this fast while also being this profitable, it's just incredibly rare. So by the numbers, it was a phenomenal quarter, which brings us to a really interesting paradox.
You'd think a quarter like that, a record-breaking quarter, would be rewarded by the market, right? People would be rushing to buy the stock. Well, that's not quite what went down.
And here is the paradox, plain as day. On one side, you have their U.S. commercial business more than doubling, and on the other, the stock price actually dropped 7%. So what in the world is going on? How can the best results ever lead to a sell-off?
The answer really comes down to expectations. First, the market was already expecting something spectacular from Palantir. It's a classic case of being priced for perfection. Second, the company's valuation was already way up there, trading at multiples that are just way beyond your typical company. And finally, yeah, US growth was incredible, but their international growth was a bit weaker, and that made some investors nervous about their global strategy. So in a nutshell, the results were great, but they weren't perfect enough to justify the huge price tag the market had already put on them.
Now, to really get our heads around this idea of valuation risk, we're going to use a bit of an unexpected analogy. It might sound a little strange at first, but let's take a quick lesson from the world of farming.
Yep, you heard that right. Tractors. We're going to look at Deere & Company, the folks who make all that John Deere equipment, to really understand the kind of cycle that Palantir is in right now. Just think about it for a second. Deere & Co. has amazing years when crop prices are high and farmers are flush with cash buying new equipment. That's a boom in agriculture. Palantir? Well, it's riding a massive AI boom right now. But for both of these companies, the big question for any investor is exactly the same. What happens when that boom inevitably cools off? One breakout quarter, whether you're selling tractors or AI software, is fantastic, but it doesn't automatically mean you're going to have that same performance for the next 5 years.
So let's pull all this together. Let's separate the hype from the reality and figure out what this all means for tech investors.
So for Palantir, the price of all its incredible potential is this constant, immense pressure to be perfect. If you're watching this company, you've got to keep an eye on 3 key risks. First is valuation, which we've been talking about. Second is execution. Can they scale this thing globally? And third is regulation. AI and government data platforms are going to face more and more scrutiny all over the world.
So what's the takeaway from all this? Here's a simple framework you can use. First, always dig deeper than that catchy headline quote. Go look at the numbers yourself. Second, assess the value. How does its price compare to its competitors? Is that high price really justified? And third, always question sustainability. Can this company really keep up this kind of explosive growth year after year? It's a great little checklist for any high-flying tech stock.
You know, Palantir's story is also just a fantastic case study for software companies everywhere. It really shows how crucial it is to move from just providing services to building high-value AI platforms. It shows the massive scale you can unlock with commercial expansion, and it proves that yes, you can have both insane growth and great profit margins. And finally, it shows that in a super crowded market, having a strong, clear story about what makes you different is absolutely everything.
So this is where we're left. Those otherworldly numbers? they're totally real. But those sky-high expectations from the market, they are just as real. And the big question is, which of these two powerful forces, the actual performance or the market's perception, is going to be the one that defines Palantir's future? That right there is the billion-dollar paradox.